Namaste. Good evening, good morning, and good afternoon, depending upon the geography you are situated in at present. On behalf of Ashutosh Financial Services Private Limited, I sincerely welcome and thank the knowledge savvy persons who have honored our invitation and joined us for the presentation on the topic Union Budget 2021-22 Income Tax and Investment Viewpoint. Over the years, the Union Budget has been the focus of the entire country, right from the common man to all those who are engaged in business and industry, financial institutions, foreign institutional investors, etc. Every year in the Union Budget, the central government makes important announcements and provisions affecting the economy as well as the taxation and financial laws. These announcements of the Union Budget give direction to our country's economic activity, which need to be understood and analyzed properly. Today's presentation will be addressed by Mr. Daxesh Kothari, who is a tax and financial consultant and the MD and CEO of Ashutosh Financial Services Private Limited. He has been providing concise and accurate analysis on the Union Budget since last 15 years. Today, he will complete his 16th consecutive year on presenting analysis on the Union Budget. Before we move forward towards the core presentation, we will play the corporate video of our company and also the introductory video of today's speaker, Mr. Daxesh Kothari, after which we can begin with the core presentation. After the core presentation, we have arranged a short question and answer session. In case you have any questions, you can ask the same in the meeting by clicking the option of raise your hand. Alternatively, you can also type your question in the Zoom chat option or in the YouTube comment section, followed by your full name. So, without wasting much of your precious time, let us move forward with today's presentation. Thank you.
Hello, everybody. For us in India, a presentation of the Union Budget all these years, I know, has been like a festival of finance. We call Diwali as a festival of lights, and I would not hesitate to say that in India, a presentation of budget, since all these years, since the time I was a child, everybody around would be talking about the Union Budget. Right from all the newspapers, in the present times, the TV channels and the social media, and everybody discussing it even on the dining table and the coffee table, all about the Union Budget. And I think it is very right to discuss about finance at least once in a year in detail, the reason being our all fortunes are connected with finance. Believe it or not, that's a fact. So these are the days when we all get connected with the world of finance and try to see how the finances of the government are going ahead, and also the way our Indian economy is going ahead. As far as the presentation of the Union Budget and its presentations that we make on the Union Budget, this is the 16th presentation on the Union Budget from our side. In these last 15 years, I had never imagined that I would be sitting in the comfort of the conference room of our office and I would be addressing people across the country, across the world. Because today, joining and listening to somebody through these means is something which has become a routine. And the fact is that COVID-19 has bought all these things along with whatever discomforts it has bought. So with these words, let us find out as to how this budget was. Because everybody, the first and foremost thing which comes up in anybody's mind is that how is this budget? How good or how bad it is? The fact is that this year's budget is an absolute growth-oriented and futuristic budget. And I have got some major concrete reasons to say this. In the detailed presentation that will follow, you will also be able to subscribe the same view that this is actually and really a growth-oriented and futuristic budget. The first pillar why I make this comment is that this is for the first time in several years that the government has chosen to have a larger fiscal deficit. By that, what I would mean is that the government is going to spend beyond what its earnings are for the reason that they have confidence in the Indian economy and they want to pump money in the pockets and in the hands of the people and don't want to trouble them by higher taxes. When it comes to the taxation front, there has been so many path-breaking, I'm using the word path-breaking things that has happened on the taxation front. Since several years, I have been watching the budget, and this is after so many years that there is a complete stability in the way the taxes and the entire structure of taxation has been. So this was something which was very much desired by not just the Indians, but the world at large who was observing India, that there should be a stability in the way the taxation is going to happen. Second, on the taxation front is that the rates of tax are quite reasonable even by global standards. And by global standards, what I would mean is not just the developed economies, but even the developing economies. The corporate rate of taxation in India is amongst the lowest even in the developing economies, the economies which are in competition with us in inviting investments. The next factor, which I would say that which is a new trend setter on the taxation front is the ease of compliance. Today, the entire structure of taxation has become absolutely e-based, completely electronic, and the compliance has become quite easy. Even somebody sitting across the world can comply their tax affairs very easily sitting in that corner of the world. So the compliance has become quite easy, and I will talk in detail of certain things which has happened in this year after the COVID crisis, and they are absolutely, keep my words, they're absolutely path-breaking, and so many of the people who are taxpayers, who are the people who are connected with the taxation and the stakeholders are not aware of this. So I would like to talk on that front in detail in the later part of my presentation. But the fact is that it has given a lot of ease of compliance. All these years, there has been a complaint from all those people who are working hard, contributing to the might country and doing something good for the country. They've always felt that the government has been robbing the rich and benefiting the poor, because there were only a limited amount of taxpayers in the country, and they used to take the burden or shoulder the burden of the entire population of the entire country in terms of expenses. So this was on the taxation front. Then the third pillar, why I call this budget as a growth oriented and a futuristic budget, is that after so many years, this budget is focusing on capital expenditure which is on building of road, buildings, infrastructure of the country. And there is a decline in the revenue expenditure. Otherwise, all these years I have been analyzing the budget that year on year, the revenue expenditure of the government, by revenue expenditure, what I mean is expenses on salaries, defense, and those kinds of expenses where we do not create anything tangible are the amounts which are going high year on year basis. But this year, a decline in the revenue being projected. So this is a very welcome feature in this budget. The fourth pillar, why I say that this budget is a budget which is growth oriented and futuristic, is that it is a budget with transparent budget estimates. By that, what I would mean is that whatever are the amounts which have been projected in the budget are quite transparent. Because every time when there was a talk about the budget and its figures, the first thing that was being said was that whatever has been estimated, whatever are the figures which are being talked about, these figures are not something which are believable. And for those reasons, people would always feel that the budgeting exercise is not done in its right spirit. This year, the government has provided everything in terms of all kinds of subsidies and expenses and everything in the budget to make it an absolute transparent document. So this makes the budget, as I said, something which is futuristic, believable, and has earned credibility for the government. Now, when any budget is prepared, it is always imperative and important to note that what was the state of the economy when this budget was prepared. So let us talk about, for a few minutes, about what is the state of the Indian economy as of now. There has been certain things or certain developments which has happened in last 10, 12 months. We know about the pandemic and COVID. Everybody in this world is impacted by it. But when it comes to the economic front, what has happened is that these events have created a new economic order, by which I would say that the ties or the economic ties of China with the world and with India are at a new low. As far as the world is concerned, we know the reasons why the world is uncomfortable with China. And for India, for the relations, whatever has happened in last 5-6 months on the border front, the relationship with China has got definitely impacted. Now, why I am saying that this is important on the economic front and this has created a new economic order? The reason is that India and the world has not focused on their own manufacturing capabilities and they have ignored the development of manufacturing in their own respective countries. Whatever has happened in last 10-12 months has seen a revival or thrust to revive manufacturing in India. As far as India is concerned, India, for its right and obvious reasons, they want to be absolutely Atmanirbhar in times to come, maybe not tomorrow, but definitely in times to come. And as far as the world is concerned, they want that, they would like to reduce the dependence upon the Chinese manufacturing and shift their basis of manufacturing from China to the other geographies of the world, which they can better depend on. The third thing which has happened in last 10-12 months is that there is a change in the US government and the new US administration is in place. The way the economic agenda of the new government is that will lead to a re-emergence of globalization. What has happened in last 4 or 5 years in the earlier US administration, that US had become more and more protective, right from granting visas, right from importing things, right from having a free trade and a globalized trade. So the economies which were supplier to to US, which is one of the biggest markets in the world, they face their own sets of challenges. Now, with the new US administration, globalization is going to re-emerge. Then another thing which has started happening is that the flow of funds in the last 4 or 5 years, the US dollar was very strong. The reason was that there was a certain level of protectionism which was carried out by the US. Now, with the new US administration in place, as I said, that with the re-emergence of globalization, funds will start moving from the US to the other emerging markets. This will lead to a slightly weakening of the US dollars in the times to come. And this has actually happened after the new US administration has taken the command. So these are the things which, as far as the events are concerned, has happened. And this is something in light of which this budget was formulated. Now, one of the best indicators of any economy and its direction is the way their gross domestic product is growing. India in 2015-16 and thereafter, the GDP growth of India was slowing and little slackening. And unfortunately, in the year 2019 to 2020, that came down to 4.2%. And in 2021, which was a completely and which is a pandemic impacted year, the GDP growth of our country is expected to be minus 7.5. So we are going to degrow in the year 2020-2021. But the silver lining is that in the year 21-22, that is the coming year, India is expected to grow somewhere in the range of 7.7 to 8.3%. And that is what makes everybody euphoric. And these trends are quite visible in whatever is happening since last at least 3 to 4 months. And that is indicating a complete V-shaped recovery. One end of the V takes you down, and when you go to the bottom, when it sharply goes up, it is called a V-shaped recovery. Why do I call it a V-shaped recovery? All these highest, which I am showing on the screen, FPI is foreign portfolio investment, foreign direct investment, car sales, steel sales, cement, consumer durables, GST collection, record high, digital transactions, electricity consumption, everything is on a record high. And that makes everybody euphoric and confident about the Indian economy. Then one another thing which anybody should watch is what is the inflation which is there in an economy. Unfortunately, inflation in India is picking up for several reasons, and this is going to be on a rise for the reason that government, the way they have conducted their finances or planned their finances in the coming year in the union budget, they have kept a substantial fiscal deficit. And this is going to lead to an increase in inflation. But at times, for the governments, there is a trade-off as to invite or to accept the evil of inflation, but to see that the growth becomes on the tracks. Then the another thing which is developing and which is important as far as the state of the economy is concerned is that crude oil prices had declined, but now they are on a rise. And so is true for all the major commodities which go into manufacturing and for building the infrastructure of the country. As you can see, from 2016, the prices of crude have progressively increased. Sometime in 2020, when the pandemic was at an absolute height and everything came to a standstill, you would be surprised to know that for a moment, the prices of crude went into a negative territory. So somebody would feel that how is this possible? But the fact is that there wasn't anybody to pick up crude, and the refineries or the people who are the producers, they wanted to get rid of those stocks, and there was no space to store crude. So from that scenario, today the crude prices have once again escalated to a certain level, and so are the commodity prices. This is very important for a country like India for the reason that India has a very high crude import bill, and 80% of our crude imports are by way of sourcing it from different countries of the world, and we have to make dollar denominated payments for this purchase of crude. Then one more aspect when we talk about the state of the economy is how are our foreign exchange reserves? Our foreign exchange reserves, despite the pandemic, despite the disturbance of global trade and our exports from India, they are at a very healthy position, which you can very much see in the figures which I have put forward before you. One of the encouraging things after the advent of this new government in India is that right from 2014 to till date, that is 1st of February 2021, the depreciation of the Indian rupee vis-a-vis the US dollar has been in all across a period of 6 years has been just 10 rupees and 85 paisa. That amounts to just 2.79% depreciation CAGR, that is an annualized depreciation across a period of 6 years. I know of times when the Indian rupee has depreciated, say 5%, 8%, and 10% in short period of times. So these are the times where India is comfortably placed insofar as the exchange rate scenario is concerned, because this is an important aspect in a country where so many of its commodities, so many of its raw materials, so many of its consumption needs are coming by way of imports. Now, in order to see what is the level of confidence that the foreigners have and the Indians have in the Indian economy, this is a good indicator. So here the figures which I have put forward are foreign institutional investments. And that is what we read every day in the news is the FII money, the foreigners' money. So anybody who wants to invest in India, and if that person is not a person of Indian origin, he cannot invest in India directly. So anybody who is interested to invest in India, or any pension funds, any sovereign funds who would like to invest in India, they have to get themselves registered as foreign institutional investors and invest in India. So the investments of these institutions are, we call it as FII investment. And what are DIIs, domestic institutional investments? Domestic institutional investments are investments by our Indian mutual funds, insurance companies, and government-backed institutions which are also into investments. But these days, the major contributors to DII are the mutual funds and the insurance companies. So that is basically Indian money. So when we look at the figures which are before us, on a year-on-year basis, if we look at 2019, then 2019, the figures of FII net investments in India and DII investments were practically equal. But when it came to 2020, the world was more confident about India than the Indians. The reason is that FII money in India in the year 2020 till 31st of December, starting from the 1st of January of 2020, there was a net inflow of 65,000 crores, while as the domestic institutional investments, the Indians, they have withdrawn 35,000 crores. So their figure is minus and FII figure is plus. Now, one of the silver lining as far as the Indian investments are concerned is a steady flow from systematic investment plans. The reason why I would like to mention is that month on month, Indians, and despite the worst times in March 2020, the contribution by Indians through the systematic investment plan in mutual funds and that being into Indian equities is to the tune of 8,000 plus crores. That totals to around 1,01,000 crores on an annual basis. So this gives a lot of stability to the way the Indian stock markets are and the needs of the Indian corporates when they want to tap the equity market. Now, the question which comes up in everybody's mind is that why are these FIIs so confident about the Indian economy and why is this stock market rising? Because the figures which I have been saying is that in the year 2021, India's GDP is going to grow by minus 7.5%. Then why is the stock market going up? The reason is that now what has happened is that there is a substantial disconnect between the way the economy at large is functioning and the way the Indian corporate profitability is behaving. The reason is that the corporate profitability in this year 2021 is going to be on the higher side. They are going to be into that positive growth terrain. The reason is that there is a return of demand for the goods and services which these corporates manufacture. There is a pent-up demand. By pent-up demand, what I would mean is that the accumulated demand of all these months has now sprung up into so many of the sectors. So that is leading for the corporate capacity utilization being utilized at the maximum. Then the Indian corporates have been so agile and robust in managing their affairs that in the COVID scenario, they have actually cut their costs. They have cut their costs on working from home, saving on so many things like maybe a travel and so many other expenses. And this has led to a better profitability. The another thing which has happened and has benefited the Indian corporates and all the borrowers at large is that the interest rates on account of COVID has come down not just in India, but across the world. So what has happened is that people who are constituting the economy at large, everybody who is the person right from the streets to the richest people in the country, when you aggregate them, yes, there is a degrowth, but when it comes to the Indian corporates, then there is a betterment of profitability and there is a positive growth. And that is the reason why the stock market is on the rise, and that is the reason why the FIIs are confident about India. Now let us look at how India is placed as far as interest rates. In the earlier slide, I talked about global and Indian interest rates. Today, the interest rates in India can be compared with the interest rates of the different or other developing economies. China, the repo rate, the rate at which the central bank, the reserve bank of the country lends to the banks and the bank in turn lends to the people, is at the rate of 3.85 in case of China. In India, it is at 4%. In developed economies, they want to pump up money in the economy and want people to borrow and spend to see that the wheels of the industry and the economy go on moving. There, the rates are in UK, it's 0.1, United States is 0.25, and for countries in the European continent, there are several countries and countries like Japan which have got negative interest rates. By that, what I would mean is the central government would say, take 100 rupees from us and return 97 or 98 or maybe 99.5, that is 0.5% less after 5 years, but lend to somebody and see that the economy is moving ahead. This is the kind of scenario which is prevailing in several of the economies. Then, if we look at how India is placed as far as the stock market is concerned, the reason why I'm putting forward this data is that stock markets are considered as a barometer of the economy and the future of the economy as is being envisaged. When you compare the returns and the way the stock markets have moved, the best has been the countries like China, which have been least impacted for unknown reasons on account of this pandemic in terms of death, in terms of infection, and the USA NASDAQ. The reason is that the companies which are listed on the NASDAQ felt the least impact of the pandemic. The countries like India bounced back well after pandemic, and that is also reflected in the one-year return of the stock market. And the countries like UK, who are still suffering from the pandemic, is evident from the way the stock market performances have been in last 1 year. Now we talk about what is the rate of growth of the top 20 economies of the world and how is India faring in this entire process. Countries like United Kingdom and India, as we talked in earlier slides, they are going to degrow. And countries like China, which were growing at 8 and 9% annually, but these countries are going to grow by at least 2% plus. So this is the kind of impact COVID had on the different growths of the different economies of the world. Now, with this background, let us go into what were the major announcements of the union budget. And these announcements which I have picked up are the ones which are going to have a far-reaching economic impact. There are so many announcements which are always made in the times when the union budget is presented, which are always there in the social media and in the newspapers. But the things which I have picked up in these 2-3 slides are the ones which, as I said, are going to have a long-term impact on the economy of the country. The first one being, and initially which I said, that the capital expenditure, the investment of the government in roads, public transport, railways, those kinds of investments is going to increase by 34.5%. That is so heartening, so appreciable. And as I was saying initially, the revenue expenditure, which is salaries, interest, defense, etc., is going to go by 2.7%. Government is going to set up an asset reconstruction company, and it is in layman terms, it is called a bad bank. So all the non-performing assets of the government banks, so the nationalized banks and even the private banks, they could be bought over by this asset reconstruction company, which will be a one-stop to resolve the matters of these kinds of borrowers, to make things more effective, fast, and to take these things to a logical end, because these companies have been into, or these companies are basically focused on these kinds of assets and its resolution. This has been an experiment or rather a successful route followed by several economies, and India is now going to follow it in a big way. The government has accepted and recognized that it doesn't have any business to be in business. So they want to divest their holdings from the biggest insurance giant being LIC of India, public sector banks, even insurance companies, and strategic sale of so many public sector undertakings. and they would like to raise these resources and spend these resources for the betterment of the economy and the quality and the standard of living of the people. The foreign direct investment limit for insurance is being raised from 49% to 74%. Why this is important? Because India is on a cusp of a situation where the need for insurance is going to rise exponentially. And when this need for insurance rises, then there needs to be we need to have well capitalized insurance companies on general insurance and life insurance side. So to see that these insurance companies do not feel the need or the dearth for capital in the times to come, that is the reason why the foreign direct investment limit on insurance holds a lot of importance. Then one another important announcement, which is very important, is that there were several laws which were governing the functioning of the financial markets. And the government has said that we will be subsuming all these things into one law, and that will be an integrated law. Then one interesting thing about defense allocation is that the defense allocation has marginally declined as far as this budget is concerned. So one always feels that are we compromising with our needs on the defense side? But the fact is that the capital expenditure on defense is on an increase of at least 20,000 crores. So all the revenue expenditure of salaries, pension, and maintenance of the entire defense infrastructure, they are to be controlled and they are to be lowered. Then certain relief measures, which I would like to draw an attention, which would lead to a substantial change in the way or rather will comfort everybody and provide relief, are that after so many years, and rightfully so, that government is increasing its outlay on health and wellness to 2.24 lakh crores, which is a rise of 137%. And they have provided 35,000 crores for COVID-related vaccines. So this is something which shows the way the government is prioritizing its expenditure. Smaller companies and all those companies who were having a limited amount of turnover and a limited amount of capital were facing a lot of difficulties in doing a lot of compliance under the company law. Now that limit has been raised for one being called as a small company. So lakhs of companies would get covered and would face a lot of lower compliance burden when it comes to the management of the businesses and that too in the corporate format. One of the important announcements from the environment, road safety and development of the auto industry is about the scrappage policy being formulated. There are several things and several discussions which are going on, but the fact is that India is going to come with a very useful scrappage policy by which after a useful life of a certain vehicle, that vehicle is supposed to be scrapped. And that will lead to, as I said, a better environment, better safety, road safety, and the development of the entire value chain of the auto sector. Now, coming to the budget per se and proper, these are the figures of the union budget. And I would like to draw the attention on those red circles which I have done in the slide, and that shows, as I have been talking right from the beginning, about the decrease in the revenue expenditure, increase in the capital expenditure, and the current year's budgetary deficit was 9.5% of GDP. So out of the total gross domestic product, by gross domestic product, what I would mean is the incomes of everybody in aggregate in this country is the gross domestic product. And the deficit of the government vis-a-vis the entire income of the country was 9.5%, for the reason that there was a slowdown in the economy and there was a lot of expenditure from the government on the COVID-related matters. That is going to come down at 6.8%. And it is being projected by experts that this 6.8% is a very fair or a very conservative estimate, and this deficit might come down and the government might be better off on account of the tax collections that is going to be very buoyant in the times to come. The fiscal deficit, the trends which we already discussed, and the trends of taxation. This year, the taxation on the direct taxes front is supposed or is being expected that despite stable rates of tax, the collection of tax would get better because the government has given a lot of focus on the development of the economy. Now, all this time I have been saying things which sound so good and pleasant. But now let me put forward things by which I would say that what can go wrong. The effects of a fiscal deficit of say 9.5% in the year 2021 and a projected fiscal deficit of 6.8% in 21-22, this can lead to a rise in inflation, which might impact so many industries, so many people, so many household budgets, so many corporate budgets. And for that reason, even the interest rates in the country might not go down anymore. And in a scenario, it might also increase. With the kind of fiscal deficit that India has put forward, and if things don't go right on the economic front, then India might face a ratings downgrade. And with the ratings downgrade, what can happen is that borrowings by Indian corporates and the Indian government from outside of India on account of our lower corporate rating could increase. So the rates of interest would get increased because the rating of the country might go down. Then the third thing which could ruin this party which is going on the stock market is the high commodity prices and the supply disruptions. High commodity prices we have discussed. There have been supply disruptions with so many of the manufacturing entities, and this has led for their uneven schedule of manufacturing and closage of certain lines of production in certain cases. Health uncertainties, we all know that they actually prevail, and unfortunately, that is a fact of life. And last but not the least, when it comes to the stock market, there is a lot of greed and euphoria. And this may lead to so many things which might happen, which might be quite unpleasant. Now, with this basic, the aspects which I have covered as far as the budgetary finances and the way the economy is moving, let us go to one of the most important portion of the budget and our presentation says changes in the Income Tax Act. And everybody in the country and now across the world, they are watching as to what are the kinds of changes which have happened. As I initially said, that this year there have been no rate change in the rates of taxation and there has been a lot of stability. But alongside that, what I would say is that there have been quite a few, and to be very precise, there have been 77 changes at different places in the Income Tax Act in order to see that the functioning and the administration of the Income Tax Act becomes robust. And this makes us very much concerned so that everybody who are the stakeholders on the taxation side are aware as to what are the changes that have happened. The first and foremost change which has happened is that, and which is going to impact everybody who are listening to this presentation, is that the due dates of filing of tax returns have been changed. So the dates for the year ended 31/3/2021, say they were 31/7, 31/10, and 30/11, as the case may be in different kinds of scenarios. But till the end of 31/3/22, it was allowed to file the tax returns. Now, either you file your tax returns in time in the dates which are mentioned in the first track, and if you fail, then your return is a belated return. And that belated return in the existing setup, it was fine if you would have filed it by 31st of March 2022. So for the year ended 31/3/21, the year which is going to end on 31st of March, the return has to be filed by latest by 31/12/2021. After that, no return would be accepted by the system at all. The window to file the return will get closed on 31/12/2021 for the year ended 31/3/2021. Then the processing of this return will also be done now 3 months earlier. So earlier it used to take by 31/3 of the next year, it was supposed to get processed. Now the government and the income tax department has said that you file early 3 months, we will also process it early. So the entire exercise that if I am supposed to get some kind of a communication from the department or the refund, those processes will also get streamlined and will go fast. Then the dates by which a notice for any scrutiny is supposed to be issued have also come down by 3 months. Then the dates by which the scrutiny assessment is supposed to be completed, that has also come down by 3 months. And if in case in the scrutiny process, if somebody does not cooperate, then the income tax department resorts to a best judgment assessment on the basis of whatever facts are available, facts and figures and details are available with them. And that is called a best judgment assessment. And that best judgment assessment, the dates also are now reduced or made a little faster by 3 months. So that entire chain of right from filing of tax return to all kinds of processing have been made faster by at least by 3 months for sure. So now the completion of accounts and the compliance process has to move quite fast. One important change which has happened on the investment front is that there has been a new provision as far as the taxation of unit-linked insurance policies are concerned. Now, this provision for taxation of unit-linked insurance policy is in respect of, let me be very clear so there is no misunderstanding, only in respect of policies which were issued or which will be issued after 1st February 2021. So all the policies which have already been existing on the ULIP, they are not going to get impacted by this change, and they will remain to be tax-free the way it used to be in the earlier times. This regulation will impact only new ULIP policies issued after the day the budget was presented. Now, this is going to impact all those policies where the annual premium paid in respect of one or more policies is in aggregate rupees 2.5 lakhs per year. So if it exceeds 2.5 lakhs per year across different policies issued after 1st February 2021, only then this new taxation regulation would apply. So under this regulation, all unit-linked insurance policies will become taxable the moment they are, as I said, issued after 1st February 2021 and where the insured has paid a premium in aggregate across all policies of more than 2.5 lakhs. Policies issued earlier will not be considered in this 2.5 lakhs limit. Earlier policies are earlier policies. Then, despite it being made taxable, any death claim in respect of this policy is completely tax-free, irrespective of the policy being issued after 1st February 2021. Then the next point in respect of this is that how would it be taxed? It would be taxed akin to mutual funds. When it comes to equity-oriented investments of the fund of the ULIP policy, it would be taxed at 10%, where the holding period is above 1 year and without indexation. And our interpretation says that if it is not an equity-linked fund, then it would be taxed as a debt fund, or rather a non-equity oriented fund where 20%, holding period being more than 3 years, it will give indexation. If it is less than 3 years, but in most of the cases, unless a ULIP is withdrawn prematurely, the holding period would not be less than 3 years. This taxation would happen at the time when the amounts are received from the insurance plan. The gray area of taxation in respect of the ULIP taxation is that it will become very complex to make calculations when there are several switches which has happened from equity-oriented to non-equity-oriented funds during the pendency of the policy. But the government has assured that it will provide or it will formulate rules to see that there are no confusions and this process of taxation of ULIPs becomes seamless. Then, as far as the reopening of assessments are concerned, there have been some welcome moves by the government. Earlier, everybody used to feel that, say, my return is being processed or my assessment is being completed. But the government had the right, or the income tax department had the right to reopen assessments to the extent of 6 years from the end of the assessment year. Now that period has been reduced to 3 years. So, for instance, for the financial year 2016-17, which is assessment year 2017-18, a reopening of assessment can be done till 31/3/21. But for financial years before 31/3/2016, that is 15-16, no reopening can be done. These provisions are going to be effective from the 1st of April, which will lead to a reduction in this number of years. But if in case, if the income which is escaping assessment is more than 50 lakhs, then this 3 years will be scaled up to 10 years. And in the cases of search and survey and certain mandatory information or certain information received from certain quarters like the Comptroller and Auditor General, the reopening of cases within this time frame will be mandatory. And if in case, if the income tax department has got some information and that is the reason for reopening, then they will investigate the matter, give an opportunity to the person whose matter or whose case is supposed to be reopened, and thereafter go for the reopening proceedings. This is a very welcome and a salutary provision that at times what used to happen was that straight away, the moment they have got some information, without getting an opportunity for the SSC to put forward his case that this is what is the explanation in respect of this information, please don't trouble me with reassessment, that opportunity was not available. Now, under section 148 capital A, this opportunity is available to the SSC. Then another provision which has been introduced to keep a tab on large amounts of purchases and sales is that an introduction of TDS under section 194Q, wherein anybody having a turnover in excess of 10 crores, meaning thereby 10 crores and above, and the aggregate purchases from some party is, or the supplier is more than 50 lakhs and above, then it will be subjected to a TDS under section 194Q. Now, if in case, if 194Q and 2061 capital H both are applicable, 2061H is tax collection at source by the person who is selling the goods. Now, this 194Q is TDS for payments by the person who is the buyer of goods. If both these provisions are applicable, then 194Q, which is the deduction by the buyer on the purchases, would prevail, and that is supposed to be done. If the purchases are covered by any other provisions of TDS or TCS, then no TDS is supposed to be done under section 194Q. In the earlier provisions that we had all these years was that if I was supposed to make any tax deduction at source and the person for whom I was making that tax deduction, he is not able to give his PAN number, then the rate of deduction will be twice the amount of the rate at which is the as such a prescribed rate. Now, one more filter has been added, that just a PAN number is okay. That's one filter. The another filter is that if that person is not filing his tax returns since last 2 years, then also the rate of taxation would be twice or 5%, whichever is higher. So if somebody does not give an evidence as to I have been filing my returns regularly, just a PAN number is not enough. A proof that I have been filing my tax returns for at least last 2 years, that is what is required for escaping this provision, or rather doing away with this higher rate of tax deduction at source. Then one further change which has been provided or which has been instituted is about the capital gains on retirement of partners or members of an AOP or partners of a firm. When they take a capital asset at the time of retirement, then capital gains would be levied in their hands on the basis of either the transaction value or the fair market value. This was something which was already existent insofar as 45(4) is concerned. But the addition in respect of this is that any revaluation of asset which has been carried out, and on that count, the value of that asset has been inflated, that is supposed to be ignored. Then another provision which is the provision which is also connected with the earlier provision which I said is provision under section 45(4) capital A, wherein if a partner on retirement receives an amount which is in excess of his capital, then that excess paid will be treated as a capital gain of the firm which is paying that money, and the taxation in respect of that excess would be in the manner that would be prescribed later on. That how it is supposed to be calculated, it will be prescribed. But the fact is that it will be taxed in the hands of the firm. Here also, any changes on account of these balances of the capital account on account of revaluation is supposed to be ignored. Then, as far as the non-resident Indians are concerned and who are returning non-resident Indians who have been working abroad, say somebody was working in the USA and they are returning back to India. Now, all those people, they have got their retirement accounts. For instance, 401k, that is the retirement account that people have and where they would be making investments into those accounts. Now, when they are returning to India, what happens is that the way the taxation prevails in USA, that only when you withdraw money from this 401k account, only then it is taxable in the US. But as far as India is concerned, the Indian taxation would say that taxation would get attracted the moment there is any income in this particular account. So in order to see that this hardship is removed, India is going to make necessary changes in the Income Tax Act, and rules specific to this would be notified. Then another set of rules which are supposed to be notified, and that is an announcement in the budget, and which is very welcome, is that rules for claiming credit in foreign jurisdictions. So whatever taxes which have been paid in India, there was a little gray area as to how one is supposed to take the credit of these taxes when they are filing their tax returns outside of India. So India is going to provide clear-cut rules as to this is the way somebody is supposed to claim the credit in foreign jurisdictions. Non-resident Indians will be now able to formulate or create a one-person company. This is a new concept wherein there is only one single shareholder in a company, which is a one-person company, and appropriate rules are set to be notified. Then, as far as presumptive taxation for professionals are concerned, under section 44 ADA, the presumptive taxation is not applicable to LLPs which are engaged in profession. It is only applicable to individuals, HUFs, and partnership firms. This has now been very clearly mentioned, and it has been clarified. then senior citizens who are of the age of beyond 75 years would not be required to file their tax returns if they have just a pension income and an interest income from the bank where they have their pension account. They need to file a declaration to the bank, and these banks would be specified banks. Government would specify that these are the banks which are allowed to receive these declarations, make tax liability payment on behalf of those senior citizens, and thereafter these senior citizens would not be required to file their tax returns at all. So many people wonder that how many people would fall in this category. But I know quite a few people who are pensioners of, say, a particular bank or a particular institution. For years and years together, they are having their pension account, and they have got that small little deposit in that very bank where they are receiving interest from. So at least for those people, this will act as a beneficial provision, and tax compliance is supposed to be done by the respective banks. Then there have been very, very important changes when it comes to the taxation of charitable trusts. All people who are connected with charitable trusts need to very carefully listen to these changes. The first change is rather applicable to certain types of charitable trusts which are running hospitals and educational institutions, and they are covered under section 1023C, 10 subclause 23C of the Income Tax Act, where the exemption limit has been raised from 1 crore to 5 crores. So this is a welcome move, and this is going to benefit these kinds of institutions. Now, one of the most important change which has happened is that for so many of the trusts, the way they used to conduct their financial affairs was they used to receive corpus donation, and they used to receive donation which is a general donation which used to get credited to the income expenditure account. Plus, they could receive, as I said, corpus donation. And this corpus donation, without any ceiling, without any limits, was absolutely tax-free, and it was something which will go straight to the balance sheet, and it will not attract any tax liability. The tax liability in case of charitable trust, the way it happens is that out of the total incomes that a charitable trust receives by way of regular donations or incomes, at least 85%, if they are not spent, then whatever is the unspent amount in that process becomes a taxable income. Okay? So as far as the corpus donations were concerned, they never entered this income expenditure account because they were considered as corpus donations. Now, these corpus donations were very freely used by the charitable trust in their overall general activities. But now the Income Tax Act has specified that if you say that this is a corpus donation, then that corpus donation has to be permanently kept in investments which have been specified under section 11 subclause 5. So whatever are the investments under the corpus donation, or rather receipts under the corpus donation, have to be invested in the investment specified under 11.5. Otherwise, they would not qualify for the exemption as a corpus donation. Furthermore, if these corpus donations were used for any objects of the trust, say donation is claimed to be a corpus donation, and it is used for any kinds of objects of the trust, making a building or for that matter, anything, any infrastructure or something, or for any charitable activities, which is objects, expenses for the objects of the trust, that will not qualify as an application of income. So if a corpus donation is received and if it is not invested in the manner as I said, then it will straight away become taxable. And the time when this corpus donation investments which was spent, that is once again deposited in the investments as mentioned in section 11.5, then that will be allowed as an application of income in the year in which, or at the time at which the same is deposited in those investments. So we need to be very sure that if we are receiving any corpus donations, they need to be invested in the specified routes of investment. If the trust has borrowed any money and it has made any expenditure for the objects of the trust, then expenditure made out of those borrowings will not be considered as an application of income for that 85% which I am looking forward to see that I am not taxed. But if there is a repayment of this loan which has arisen on account of that application of income, then that will be allowed as an application of income. If in a particular year there is any set off or deduction or excess application of any amounts by the trust. So this year the donations are say 5 lakhs and we have spent 7 lakhs. So there is an excess spending of 2 lakhs. But that 2 lakhs will not be allowed as a carry forward in the next year as an expenditure which could be considered for the next year. Then the provision which was put forward in the last Finance Act was that under section 44AB, the limit is 1 crore. But if somebody is having all his receipts in modes which are other than cash, 5% leeway is allowed. To the extent of 5%, it is okay. Beyond that, if all the amounts of gross receipts are by way of modes other than cash, then the tax audit limit in last year was 5 crores. That has been raised to 10 crores. Here, I would like to clarify that the payments would include, and receipts and payments would include not just the receipts and payments of the trading and profit and loss account, but the receipts and payments on the balance sheet side also. So we need to not just take into consideration the purchase and sale in that particular year or expenses, but also loans or deposits which has been transacted in that particular year. Then one another strict provision which has been provided in the interest of the employees is that if an employer has deducted employers and employees contribution, employee has deposited, so employee contribution has been deducted from the salary, and employer contribution is something which they are supposed to make, and if that amount is not deposited by the due date, say if 15th is the due date, it is 15th, not even 16th. If it is not deposited on 15th or by 15th, then the employee's share will be added as an income because you have deducted from the salary of the employees and you did not deposit in time. There is no relaxation whatsoever for whatever reason that I could not reach. It was a holiday or anything. The moment 15th is the last date and it's 16th is the day when you have paid, then the entire employee's contribution will be added to the income. As far as the employer's contribution is concerned, then section 43B would be operative, wherein before the due date of filing of the tax return, if that amount has been paid, then that amount would be allowed as a deduction. But the government is very clear and strict that if employees' monies have been deducted from salary, there should not be any delay. And if there is a delay, then we'll make this amount as taxable. Then another provision which has been introduced to give a little amount of relief to people who are buying residential houses is under section 43CA, which states that if say the sale consideration is say 100 and the stamp duty value of that property is say anything which is less than 120, right? Say in that scenario, there will not be any implication of income, because otherwise, if there is a difference between the sale consideration and the stamp duty value, which we normally called as the jantri value, then we will be supposed to pay tax on the stamp duty value, irrespective of the fact whatever is the sale consideration. But a leeway has been given to the extent of 20% for other properties, for other transactions. Last year, the leeway was raised to from 5% to 10%. That remains the way it is. But as far as certain situations which I have mentioned, those three situations, then that legroom has been raised from 10% to 20%. So what are those conditions? That the transfer is in respect of a residential unit, and it is between March and June 2021, dates have been specified. It is the first time allotment of a residential unit, and the value of it is not exceeding 2 crores of rupees. Then there have been some changes in the way real estate investment trust and infrastructure investment trust units are being taxed. I have laid down in the table very clearly. So all those who are really interested in it can take a snap of it. I will not go into details. It is a little technical thing. And but these things are now becoming, these RITs and InvITs are becoming very common. And this is the way the country is going to grow forward, that so many of the real estate assets and infrastructure assets will now be in the form of financial assets, which will be converted into units, the way it is in case of mutual funds. And everybody and the people at large will be able to participate in those real estate assets and infrastructure assets. This is the further, these are the further details of the taxation of RITs and InvITs in respect of whatever incomes are generated from RITs and InvITs. Then this is the taxation as far as the taxability at the time of transfer of these RITs and InvITs. Now, there has been an absolute changing scenario, and the winds of change are blowing very much on the way the entire income tax compliance and the way the entire income tax machinery is being conducted. In earlier times, if somebody had got a dispute after an assessment was completed, then they had to go for an appeal. Now, what the government has provided is that they are going to start a dispute resolution committee, wherein small-time assessees, those assessees who have got incomes which is less than 50 lakhs, and the variation of their incomes in the course of assessment is up to rupees 10 lakhs, they can go for this dispute resolution committee and get their dispute resolved. This will not be applicable in cases of search, survey, and double taxation or treaty-related cases. And this DRC will have the powers to waive penalty and waive prosecution if it was instituted in the course of assessment proceedings. Then the time limit for affordable housing for first-time home buyers have been raised from, it was earlier 31/3/20, now it has been raised to 31/3/2021. So the sanctioning of that loan for affordable housing has to be before 31/3/2021. Then one can get an additional reduction under these provisions. Then the settlement commission, which was something which was very useful to so many of the SSCs who are high profile SSCs and where complex matters were involved, they used to approach the settlement commission. The settlement commission for several reasons is set to be abolished, and that is being done from an immediate effect. And all the pending matters with the settlement commission will go to an interim board, and detailed arrangements as to what is going to happen with the matters which are already pending before the settlement commission as of now, what options would the people who have made applications to the settlement commission would be available. Those arrangements are being made, and they would be notified. And they have been already, quite a few have already been provided. So over a period of time, this interim board will settle all the pending matters of the settlement commission, and the settlement commission as such has come to an end right from 1st February 2021. Another change which has been proposed is that goodwill was considered as a depreciable asset, and depreciation was allowed on it. Now, the government by amendment has clarified that no depreciation will be allowed on goodwill, and if goodwill was added to the block of assets, then that portion of the written down value of that block of assets would be removed, and thereafter whatever is the residual value after depreciation will be the value at which the goodwill will remain, and no further depreciation will be allowed on it. For cases of non-resident Indians and transactions with non-residents, and in case of certain large transactions, there was a facility of advance ruling authority which was available. So that authority of advance ruling would in advance give their verdict that this is the way we will view your proposed transactions. Because when a non-resident is, say, planning some investments, planning some kind of activity in India, and if they are not clear as to what will happen to something on the taxation front, then they want clarity. For those purposes, this advance ruling authority was created. This advance ruling authority will now be a board of advance ruling, and it will be manned by chief commissioners, and order of a board of advance ruling can be challenged in the High Court. Now, in the last leg of my presentation, I'm going to touch something which is extremely interesting. So many of the people, so many of the SSC, they really don't know about what has really come on the e-assessment front. This is, as I was telling earlier, absolutely path-breaking and unheard of in a country like India. As far as filing of tax returns was concerned, since a few years, it was all e-filing. So now that is something which is by and large absolutely mandatory, e-filing. If I want to get register myself as a taxpayer, PAN number or a TAN number or something, that registration is e-based, is electronic. tax deduction at source is ETDS filing of returns. The tax administration is now going to be absolutely, mark my words, absolutely electronic. It will be completely devoid of any human interface. And that is what is going to be e-assessment. And if in case, if my return or e-filing is processed and I am supposed to get a refund, then I will get it electronically. And if in case, if the department is not happy with my tax return, then e-assessment will follow. How it will be done, I will talk in the next slide. But if in case, if I am not even happy with the e-assessment, then the process will again go to e-appeals. So now the first appeal, which was the Commissioner of Income Tax Appeals, is also now completely electronic and e-based, and there is no human interface when it comes to appeals also. Now, how this scheme of e-assessment is going to function? The taxpayer will communicate with only, mark my words, only with the National E-Assessment Center. It will receive notices from the National E-Assessment Center. It has to file replies to the National E-Assessment Center electronically. Then there is not going to be any human interface, no human interface. The jurisdiction will be dynamic in the sense that it will not be that I am supposed or I'm assessed with ward XYZ of this place. This fellow is my assessing officer. No, it is a dynamic jurisdiction wherein everybody in the country is assessed by only one authority, is the National E-Assessment Center. The National E-Assessment Center is also not manned by one person or a few persons or even a large set of persons. They are working in a team. So there are regional e-assessment centers where there will be an assessment unit. There would be a assessment unit where all the replies that we furnish to the National E-Assessment Center would go. Now this assessment unit, there will be regional assessment units. So my case from Rajkot might be assessed by an assessment unit in Bangalore, and these assessment related proceedings, they might go to a verification unit in Mumbai. It will be supported by a technical unit on, if there are any technical or legal issues, by a technical unit which is based in Ahmedabad, and the entire process could be reviewed by a unit which is based in Chennai. So there is no single person who is going to assess, and it will be assessed as a team, and that too in 4 different teams located at 4 different locations, and they would be entrusted these things on a dynamic basis. Each of this team will be specialists in these functions. Now this e-assessment, the basis of this e-assessment is going to be on the basis of, one, the filings that we do, the assessee does, filings by others. So they have stated in their returns of income or TDS returns or TCS returns that these are the transactions with the other party, that will act as a basis for e-assessment. Then annual information return, banks, registrar offices, post office, so many of the institutions are supposed to provide annual information to the department. Information from other laws like GST, company law, and several other laws. Data mining by say, data from different sources, and that will all be done in a manner, in a computerized manner, where human intervention is not involved, and certain set algorithm will be working. And last but not the least, artificial intelligence, which will even mine the data on the social media. So what will this lead to? Completely faceless proceedings without no human interface at all. The entire proceedings will be jurisdictionless, it will be paperless, and all replies have to be time bound. The reply, say, is supposed to be submitted within 15 days. The submission window will stay open only for 15 days. Thereafter, the window will be closed. So one has to be very vigilant in all these things. And last but not the least, and the most important, that this process, the way it has been designed, it is not just corruptionless, but beyond a thought that corruption will be possible in this entire process. So these are the major changes which have happened in the last few months. And to take it further in this budget, the announcement is that the first after the first appellate authority, which is the Commissioner of Income Tax Appeal, the next appellate authority, which is the Income Tax Appellate Tribunal, which is the highest level before the High Court, and which is the final fact-finding authority or fact-finding forum where you can put your facts forward, is also going to be faceless, online, and the mechanism in respect of that is going to be notified in times to come. With these words, I would like to read out a message which the then celebrated Finance Minister Dr. Manmohan Singh said at the time when he presented the historic budget, which changed the way the country's reform, the direction in which the economic ship of the country moved thereafter, which was a landmark budget, as we all know, of 1991-92, where he quoted Victor Hugo, and he said that no power on earth can stop an idea whose time has come. I suggest this august house that the emergence of India as a major economic power in the world happens to be one such idea. Let the whole world hear it loud and clear. India is now wide awake. We shall prevail, we shall overcome. So this is a message which was quite relevant in 91-92, and this is a message even relevant today, and especially after the way this budget has been presented, putting a lot of confidence in the India which we all love. I thank one and all for participating through Zoom and YouTube. And I would like to thank my entire Ashutosh FinServe team who works day and night after the budget is out to prepare this comprehensive presentation in a short time. You can follow us on YouTube and various other social media and on our website. This entire presentation and this YouTube video will be available on the social media and our website. Tomorrow at 11 o'clock, there will be a repeat presentation in Gujarati if somebody is interested into. Whatever I have said in this presentation are my personal views, and this should not be construed as any advice. In order to take any action, one should take appropriate professional advice. And wherever I have put forward any references, I have mentioned the sources where I have borrowed this data from. With these words, I would request you to send a feedback message on these WhatsApp numbers. We will be extremely grateful to you if you can send a feedback message that will connect you and keep you connected with us for all the updates in the world of taxation and finance. Thank you very much. And I will take up questions if there are any for another 10-15 minutes. Please.